And good morning. This is Victor Bales over at USA Mortgage. Today is Wednesday, May 3rd. What's going to happen today in the mortgage world? Well, the feds are expected to raise the prime rate by another 0.25% today for about the 10th time in a row. What does this mean for mortgage interest rates? Well, ultimately, it's going to help mortgage interest rates. Remember, the feds are raising the prime rate. This is for short-term lending. This is for credit card interest rates, automobile interest rates, home equity lines of credit. They are trying to stop you, the consumer, from spending, because if they can stop you from spending, means there will be more supply out there. And if there is more supply, that means less demand. Less demand means lower prices. Lower prices mean lower inflation. Lower inflation means lower mortgage interest rates. Okay. Mortgage interest rates 100% of the time will follow inflation. Remember back in the pandemic, inflation was down near about 0.5%. Where were mortgage interest rates? About 2.5 to 2.625%. Right now, we've got a very tight home inventory out there for home buyers, and we got a lot of sellers out there that did get these mortgages back a few years ago in the 3s and the 4s. And if they sell that home, they're going to go get a mortgage in the 6.5 to 7% range. That's kind of a hard pill to swallow. But next week, and I actually think this week we are at the bottom of the market, because next week, with all the attempts the feds have been doing to raise the prime rate to stop the spending, it's starting to take hold. We have 300,000 less jobs this month available than last month. That's downward pressure on inflation. So as we move forward, next week on May 10th, the Consumer Price Index report comes out, and that measures inflation. We expect these numbers to come in much lower than they did last month. And I think we're going to be on the next 6 months, this inflation is going to continue to go down. And when that comes down, mortgage interest rates will follow. And if that happens, what's going to happen is this is going to break that home inventory, because those people with those low rate mortgages who want to sell can't see themselves going in the 6.5 to 7% mortgage. Well, now, if these rates continue to come down and they get under 6%, that may be an easier pill to swallow and to list and buy. So this could help us out. What we're also going to see, I think this is going to spark a cash out refinance debt consolidation. Right now across the country, we got credit card debt at one of its highest it's been, and also the savings is dwindling. But Americans are not giving up the lifestyle. They are going out to eat. They are traveling, regardless of the current economic conditions. However, I think with lower rates, this will create an opportunity to consolidate that debt and also reduce that overall monthly cash outflow. So I think for the next 6 months, we're going to see downward inflation, which will lead to lower interest rates, and it's going to kickstart this market. So I think we're going to have a lot more inventory coming. Thanks for holding on throughout that last year and a half. That was a rough ride, but I think we've hit bottom. The light at the end of the tunnel is turned on. And if anybody ever has a question, just respond to this email. Give me a call, 734-417-2115. I'd like to talk about your situation and how I might be able to help you out. I will talk to you soon. Bye-bye.